What's up, everybody? It is no secret that the U.S. housing market is in serious trouble, and our affordability crisis is at an all-time high, and rising mortgage rates is not helping. It seems like all the forecasters have been terribly wrong in their predictions, so can we really trust them moving forward? The big questions are, will interest rates continue to go up, or will buyers see some relief in the next year, and will home prices finally come down enough to offset these high mortgage rates? A lot of good questions, so let's see if we can find some answers. But even if we do, can we really trust them? Today, we'll look at an article by Lance Lambert titled, "Where Forecasters Expect Mortgage Rates to Go in 2024, Can We Trust Them?" As well as some other predictions on the future of mortgage rates, as well as the housing market. And as always, I will chime in with my opinion as well. So, let's dive right in. According to Wells Fargo economists, rising borrowing costs stand to tip the housing sector back into a recession as mortgage rates hover around 8%. The average 30-year fixed mortgage rate increased to 7.79% for the week ending October 26th, according to Freddie Mac's latest primary mortgage market survey. That's an increase from the previous week when it averaged 7.63%. A year ago, 30-year fixed rate mortgage averaged 7.08%. For the seventh week in a row, mortgage rates continue to climb towards 8%, resulting in the longest consecutive rise since the spring of 2022. Freddie Mac chief economist Sam Kater said, "Purchase activity has slowed to a virtual standstill. Affordability remains a significant hurdle for many, and the only way to address it is lower rates and greater inventory." As of now, inventory is still a major problem in most housing markets, as would-be sellers are choosing to stay where they are rather than trade in their low interest rate to then go buy something with a much higher rate. The existing home market still suffers from low inventory, as many current homeowners choose not to list their home for sale, opting out of forfeiting their lower rate mortgage for a loan at today's rate, said Realtor.com senior economic research analyst Hannah Jones. Existing home sales fell to a decade-plus low in September, and competition over scarce inventory pushed prices higher year over year. Jones notes that some borrowers are already seeing rates beyond the 8% threshold. The milestone of 8% plus mortgage rates, like 5% treasury yields, emphasizes the financial headwinds facing borrowers in today's market, Jones said in a statement. For mortgage rates to improve considerably, investors will need to see that economic growth is slowing, which would suggest that inflation is making progress towards 2% and that the Fed can pause and eventually pivot their contractionary policy. I agree. If inflation does progress down to almost 2% and the Fed does start to lower interest rates, buyers will get a break when mortgage rates start to go down. But will this actually happen? And if rates do go down, will prices simply go up higher due to more competition if more buyers enter the market? So far, the forecasters have been very wrong. Lance Lambert writes that in late 2021, the Mortgage Bankers Association was forecasting that interest rates would be 4% by the fourth quarter of 2022, while Fannie Mae had a different estimate, suggesting mortgage rates would rise to 3.3% by the fourth quarter of 2022. The outcome, however, defied these expectations. The average 30-year fixed mortgage rate averaged 6.7% in the fourth quarter of 2022. Fast forward to 2023, and history seems to be repeating itself. At the beginning of the year, the Mortgage Bankers Association predicted the average 30-year fixed rate would fall back to 5.2% by the fourth quarter of 2023. And Fannie Mae predicted the average 30-year fixed rate would be 6.1% by the fourth quarter of 2023. As of this week, the average 30-year fixed mortgage rate, as tracked by Freddie Mac, is 7.79%. And as for 2024, Fannie Mae expects the 30-year fixed rate to average 6.7% by the fourth quarter of 2024. The Mortgage Bankers Association predicts 6.1% by the fourth quarter of 2024. And Goldman Sachs expects the 30-year fixed rate to average 6.8% by the fourth quarter of 2024. At least that's what they're saying now. Back in May, Fannie Mae was predicting that the 30-year fixed mortgage rate would average 5.4% in the fourth quarter of 2024. Now they're forecasting 6.7%, while the Mortgage Bankers Association was predicting predicting 4.8% for the fourth quarter of 2024. They're now forecasting 6.1%. In other words, forecasters are coming to terms that the resilient economy and determined Federal Reserve could see financial markets keep yields and interest rates higher for longer. A higher for longer interest rate environment would most likely not only weigh on demand, but could also constrain supply by reducing new construction and discouraging prospective sellers carrying low mortgage rates from listing their homes for sale, Wells Fargo economist wrote. Although the bank has downgraded their home price forecast, they are still predicting home prices will go up in 2024. Higher financing costs are likely to both weigh on demand and constrain supply, which will allow home prices to maintain a positive trajectory, Wells Fargo economist wrote, predicting the S&P Case-Shiller National Home Price Index to increase 1.8% in 2023 and 2.5% in 2024. Wells Fargo economists are also downgrading their forecast for residential new construction starts, with multifamily permits already declining sharply in recent months. The recent drop in home builder confidence is evidence that single-family construction may begin to moderate as higher mortgage rates test builders' ability to offer rate buydowns to attract new buyers, they wrote. That noted, a structural shortfall of single-family supply will likely continue to boost new development. Once again, low inventory is the motivator for new construction, even with these high interest rates, as buyers are antsy for choices of homes to buy. According to a new report from the National Association of Realtors, the number of home sales has decreased 15.4% from a year ago, while home prices increased 2.8% during that time. As has been the case throughout this year, limited inventory and low housing affordability continue to hamper home sales, said NAR chief economist Lawrence Yun. The Federal Reserve simply cannot keep raising interest rates in light of softening inflation and weakening job gains. The overall inventory is still around 700,000 homes, according to the St. Louis Fed, double the record low of 353,000 from January of 2022, but still below the 1.4 million on the market in 2016. Lambert writes that a game changer, of course, would be if the Federal Reserve shifted from tightening mode into easing mode sooner than expected, or if spiked rates pushed the U.S. economy into a recession. In many ways, the housing market experienced 4 years of business in a 2-year period between mid-2020 and mid-2022. With ongoing affordability constraints and rising mortgage rates, much of that activity has essentially been given back. We expect the higher mortgage rate environment to continue to dampen housing activity and further complicate housing affordability into 2024, writes Fannie Mae chief economist Doug Duncan. And Chen Zhao, the head of economic research at Redfin, said, despite what the Fed has done, hiking rates at the fastest rate ever, the economy, especially the job market, has really just remained very resilient. As a result, investors are now expecting that the economy is going to avoid a recession and remain very strong for longer. And that means that the economy can sustain higher mortgage rates for a longer amount of time. As for the future of home prices and mortgage rates, I would be wary to believe any of the experts right now. There's just too much uncertainty with multiple wars overseas and our own complicated politics domestically to confidently predict the future of our economy and the housing market. I would say that right now uncertainty is unusually high, Zhao comments. Maybe the most plausible forecast would be to say that rates are probably going to stay in this range for the near term, or at least in the foreseeable future. Zhao also outlined scenarios for mortgage rates to go lower, an economic downturn forcing the Federal Reserve to encourage economic activity by easing interest rates, or higher if mortgage spreads remain elevated. According to Redfin's latest housing market update for the 4 weeks ending October 22nd, the median asking price is up 5.4% year over year, the biggest increase in a year. Nearly 30% of the homes for sale sold above the asking price, up from 28% a year ago. 38.3% of the homes sold within the first 2 weeks, weeks, up from 35% a year ago. 6.8% of the homes for sale each week did have a price drop, a record high. The median days on the market was 33 days, down 3 days from a year ago. And the months of supply was 3.5 months, the highest level since February. All this to say is that real estate is very localized, and what's happening in one part of our country can be very different than in another part. I hope you got some value to today's video. I know these are very uncertain times, and I am very sensitive to that. So I'm just trying to bring you the best information that I can gather so you can make the best decisions for you and your family. If you missed last week's video on the article in the Washington Post about our housing market being completely broken, definitely check that out next. Thanks for watching. I do appreciate it. Bye!